selling options is still a form of risk taking. You are still gambling when you are selling an option. Even though you're not buying it, it's still gambling. Again, I don't know how many times I have to say this to make it clear. Selling an option is still a form of risk taking. So recently there's been a lot more, I guess, hubbub and a lot more people kind of promoting selling options, which in my opinion, I really do like selling options. It is an option that, not pun not intended, but it's something that you can do for increasing like some type of like semi-passive income. But recently there's just been a lot more, people have been, I guess I've been seeing a lot more influencers and a lot more kind of blogs talking about like, oh, selling options is the next big thing, and like you don't have to worry about the risks or whatever. You're the casino when you're selling an option, and the casino always wins. That is so far from the truth. And like, yeah, you do get this passive income, and yes, oftentimes you can look for options where you're more likely to win. And even in a previous video when I talked about some statements that Jerome Powell made, I also recommended, oh, this right now is a pretty good time where you'll have high volatility and the market won't really know what to do. So I recommend you selling calls on pops and selling puts on drops. But I just feel that just in YouTube in general, there's a lot of people that are promoting options, and I feel like they just don't know what they're saying, or like they I don't know what it is, because they're saying it like it's this golden goose that will lay a bajillion like golden eggs and you can't lose. But the reality is you can lose. And I've been seeing people getting more and more ballsies with, oh, you can sell a zero DTE or 0 day to expire options on the Qs. Oh, you should sell credit spreads and yeah, you should sell credit spreads, credit call or call credit spreads, put credit spreads, because you get higher premium, you get a better yield on your money. There's a reason why you get a better yield on certain things. There's a reason why you get higher premium on certain things. It's because there's higher risk, right? There's a higher calculated risk or expected risk that you're shouldering when you're selling those options or when you're selling those credit spreads. I want to make this clear that I can't express how much I love options, just because I feel like it's such a good tool to use when in a lot of circumstances. But I just feel that the risks of selling options are completely ignored. And I want to make this video specifically about credit spreads, because I feel like that's been getting a little bit more popular just because of the increased yield, right? So like you can bet on stocks like Apple, Nvidia, Tesla, whatever, without having to buy 100 shares or without having to have the capital to buy 100 shares. You only need to have a much further spread, maybe a $5 spread, $10 spread, $15 spread. So honestly, like the reasons to selling a credit spread, it's very enticing, right? Some people if you annualize it, those numbers are huge. But again, there's more risk in that. The first thing I want to talk about is these websites that have these expected risks, right? Or your success ratio. Sometimes they'll say like, oh, it's 95% success rate, 97% success rate, 99% success rate, whatever. I want to ask you, where do you think they're getting those probabilities from? Those probabilities have already been calculated into the option price, right? What makes an option scary and it has nothing to do with these probabilities, right? Because think about it, because the option price is calculated based off of exactly the same things this options calculator is calculating. They're looking at volatility, they're looking at days to expiry, they're looking at delta, gamma, they're looking at all those things. So because both the option price and the probability of the option getting in the money are both calculated on the same thing, if these probabilities were actually accurate, right? If they were actually right, if these probabilities meant anything, then on a long-term basis, you wouldn't make any money, because these are all just calculations, right? So eventually they would even out to where your win-loss ratio matches the success rate probability, right? thing about options is you have to account for those black swan events. And when you account for those black swan events, what you have to take into account is your risk reward ratio. Okay? Now, the reason why I say credit spreads are a lot more dangerous than calls or puts is because when you're selling a call or when you're selling a put, you have an expectation, or not an expectation, but like you should be okay with the end result regardless of what happens. So you should not be crying home to your mom when your stocks get called away, because before you sold that call, you should have been thinking, okay, well, I mean, I'll earn some passive income in the meantime, but I don't mind if my shares get called away. Or if you have a put, before you sold that put, you should be thinking, okay, well, I want to buy the stock at this price anyways. So while we're waiting for that stock to hit that price, to drop down below that price, I might as well make some extra money. That should be your mentality when you're selling a call or a put, right? It should not be like, you should not be like flipping a coin and looking at premium and saying, okay, this one has high premium. I don't want to hold the stock, but there's high premiums on puts, so I'm just sell a put. Because I'm assuming you should have that mentality before you sell a call or a put. I actually really like calls and puts, right? I really like one-legged options because you basically get income for doing something that you would have done, or like with or without the option, right? Namely, having a limit order to buy or a limit order to sell. Now, the problem comes with credit spreads. And I heard this quote the other day that was, it's so stupid. If the chance of the risk is low enough, then it doesn't matter what my risk is. Something along the lines of that. And that is so scary of a phrase. If the chance of something happening is low enough, then the risk doesn't matter. That goes against everything I've been saying about black swans and all those things, right? Because the probability, right? Again, going back to how options are calculated, how option prices are calculated, the probability is only based on the known factors. But how option buyers win is by betting on unknown factors, i.e. black swans, right? And basically what that means is, and honestly, as of now, and especially in this market, in this political scenario, right, where you have uncertainty everywhere, right? Trump could say anything at any time and do anything at any time, and no one would know anything. No, what would you do, right? It could send stocks mooning, and it could send stocks like falling off a cliff. And just look at our stock market in the past month, 2 months. It's been a huge roller coaster ride, and I'm sure that so many people selling credit spreads have been caught with their pants down. I just have to say that the risks in selling a credit spread are there's definitely more risk in selling a credit spread than there are in selling a call or a put. And you might say, oh, but I can always roll out. I can always roll out my credit spreads or my calls or puts. And I'm gonna talk about that later. But first, I want to talk about just the idea of, oh, well, because you get so much more, you get a much better percentage, like reward, based off of what you're risking, right? Your capital. Let's say a good credit spread, maybe you'll get like 3, 4, 5%, a good safe one, right? I don't want you getting 20%. Please do not, please do not be selling credit spreads that net you 50% risk reward ratio. That is so scary. But I mean, you do whatever you want, right? Like, I can't control you, but like a good credit spread, maybe like 3, 4, 5%, like you'll get your money, like you'll get 3, 4, 5% of your risk. That means, right? That's a pretty high, like, in return on investment, right? 3, 4, 5% in like what, 1, 2, 3, 4 weeks? That's really annualized. Damn, annualized. Whoa. Even if it's 5%, right? If it's a 5% return on your on risk, right? That means you have to be right 20 times for every one time you're wrong. 19 times? Oh, to break even, 19 times to every one, right? But to actually win, you have to be 20. You have to be right 20 times for every one time you lose. Can you be sure of yourself that that will happen, that you will be able to win 20 times for every one loss? Now let's talk about rolling options. Wrong button. Okay, so when you're rolling, so how is an option price calculated, right? It's book value plus premium above book, right? And what is that? Well, what is premium? Or I guess it should be extrinsic value, not really premium, because technically, whatever. Premium is some function of the volatility, the time remaining, and delta, which is the strike price in relation to current price, which I have this as a ratio. I don't know, but basically this is delta. So that's how you calculate the option price, right? This is basically just, this function, in other words, is just probability of the stock getting into the money. That's honestly what this is. Now let's talk about how you roll a call or a put, right? So when you roll a call or a put, you have your first option, right? Which is probably going to be in the money if you're rolling. And you have your second option, probably going to be you either want it to be out of the money, or if you're ballsy, then you can keep it at the same price. Let's just say you're rolling to the same strike price of, let's say, $10 strike to $10 strike, right? In that case, then the book value is canceled out and you're just left at premium. Well, when you look at premium, for this first option, premium should be 0. Because once you have 0 time left, you have 0 probability of the option moving any which way direction. So premium, when you're rolling this first option out, should be approaching 0. So basically that means that price is just going to be equal to book value, right? So this is 0. Now, when you're rolling out to a later expiration, you know that premium is non-zero, right? So at least this does something. And the other thing that's actually pretty important is volatility. If you were perfectly fine out of the money, right, and then all of a sudden the stock jumps for some unknown reason. The good thing about that is, even though this first option is now in the money, the thing is, because they only got in the money because volatility somehow increased, right? So that means that what made this option go into the money and forced you to start rolling actually is helping you in finding an option that has enough premium to cover whether you want to increase this book value or not, if that makes sense. Because volatility increased and pushed you into the money, now since the entire stock has the same volatility, well, then this premium also increased, and it might have increased enough where it can cover you going rolling up in strike price to actually push the option strike price higher up. Basically, the volatility that forced you to roll made it also easier to find an option up and out to roll to. Now let's look at rolling credit spreads. So when you sell a credit spread, you have your premium, which is the price of the option of the first option minus the price of the second option. Again, same exact formula, right? So it's not plus, right? It's some equation, but like this, intuitively, your option price is just book plus time plus delta plus volatility, and then your premium that you received after selling this credit spread is this option price 1 minus option price 2 on the bottom. Now, if you do some other calculation, well, first of all, when you're selling a credit spread, books should be 0, right? You're not selling in the money credit spread unless you could be if you're waiting for the stock to actually reverse in momentum or whatever. But most of the time, you're not selling in the money credit spreads. So we can remove, this one. This is initially 0, but time and volatility also should cancel out because they're the same. It's the same underlying stock, right? So and it's because it's the same underlying stock and it's the same expiration date. So times should cancel out and volatility should cancel out. So all you're really getting is this difference in delta when you're selling a credit spread. Okay, now let's say you're rolling out. Let's say you're rolling this credit spread. Again, same exact formulas, right? But now, because you're rolling the credit spread, I'm assuming that this credit spread is now in the money, right? Because that's the only reason why you'd be rolling out, or if you think it's at risk of being in the money. So, what does that mean? Well, this all goes to 0 again, right? Because options end of life premium, or this extrinsic value becomes 0. But this difference in book is non-zero now, right? It is significantly non-zero, and it might be approaching your max risk. Now let's look for an option you're trying to roll into, right? You're trying to roll into this option, And there's no, how do you, okay, let me just, explain. Okay, so again, this time and this volatility should cancel out, right? Because it's the same underlying, right? So we're only looking really at book value and delta. So now you're trying to go from this significantly non-zero book value to hopefully a book value spread of 0. When you're rolling, you're trying to roll up and out so that you actually are no longer in the money, right? But so that basically means that this book value, like this book spread, you're aiming for a book spread of 0 because you wanted both legs of the option spread to be out of the money. So this is 0, but this is significantly not 0, right? This might be approaching your max risk. So that means you only have delta to hopefully cover your max risk. And the difference in delta is pathetically insignificant to the difference in book value most of the time. So it's much harder to find a good credit spread to roll out into where the spread and the difference of delta covers the spread and the difference of book value. Like this is all like really high level because I mean like, so let's say you're rolling like a 5-10 credit spread and you want to go to like a 10-15 or like a 15-20 credit spread. This delta is so small compared to your max risk, which is $5 or $500, right? Hello? It's much harder to find something. The other way you could do it maybe is if you increase your risk from maybe saying a 5-10 credit spread, and now you're going to write what, like a 15-30 credit spread. You're going to triple your amount of risk just so that you can roll out. Is that what you want to do? That is it. And then who knows what the stock could do? It could go even higher, and then you have to triple it again. It is so much more different rolling out credit spreads, and I just want to talk about it. Yes, it is higher. You do get more income, but it doesn't come without its risks. And these are the risks. And I feel that, in my opinion, right, if unless you truly know what you're doing and you truly accept the fact that yes, you're risking your max risk, a rollover is a much less powerful get out of the jail card when you're rolling credit spreads as compared to when you're rolling single-legged options. So yeah, this is a long video, just me saying options are good. I love options, right? I encouraged writing options multiple times, but do realize the risk. And just because a risk might seem insignificant, it might be Thanksgiving and you might get chopped, okay? Please, what you have to account for is large left tail risk and large right tail risks, right? You don't know what's going to happen. Like, you should fully accept what happens if shit hits the fan. And if you can't do that, like I said before, right? With calls and puts, it's much easier to accept what happens if shit hits the fan because you either get put the stock or your calls get called away, right? That's a much easier to accept because it's easier to just see it as a limit order to buy or sell. But then with credit spread, you just lose the money. There's no consolation prize. You just lose it. I don't know if that, I feel like I've said a lot of things that maybe I went over a lot of people's head, but just be careful, okay? Like, risks are really real, right? You have to be, like, no one expected the .com crash. No one expected Black Monday. No one expected the Great Financial Crisis. No one expected the Great Depression, right? And I'm sure they had probability calculators back then, right? I'm sure they had a bajillion statisticians back then talking about, oh, well, this is the risk of this happening. No one knows, right? Tomorrow, Trump could say anything. The next week, anything happen, right? Putin, Xi Jinping, anyone, Trudeau, even, I don't even know, whatever. Anyone could say anything, and you just don't know, right? So just be careful, and yeah. Have a good day. I'm done.